Hi Year 11. This video is going to focus on the introduction to our fifth topic of study, which you know is financial markets. So please have the handout with you, a pen, a highlighter, as well as your drive, because we'll be using both the annotation on the printed handout as well as some activities that you'll need to complete with documents that I've placed in your drives. All right, pause it now if you need to get that sorted, and let's get started. So pretty much what is this topic about? Well, we need to look at the operation of the financial markets in Australia. So we're looking at the movement of funds and financial flows. We're looking at institutions involved, okay? And that won't be covered directly in this video, but a later activity. Looking at regulation and control of market outcomes, different types of markets, and that's one of the first things that we're going to talk about. And then later on in this unit, we're going to do a depth study on the Reserve Bank of Australia with the role of themselves in the cash rate and interest rates. So a fairly broad unit and a unit that will help you and give you some foundational concepts for HSC next year. So some really important stuff. Before we begin, here are some key words: debt, equity, bonds, securities, shares, financial capital. Pause this now, have a read of them. I'm not going to go through them, but I will be using these and assume that you know what they are. So pause now, make sure you know what they are. Okay, pretty much the financial system provides a channel or a way for funds to be exchanged between lenders and borrowers. So we do want to increase our economic efficiency through financial flows. Now these happen in both a domestic and an international sense as well. When we talk about lenders, we're talking about the supply of funds, okay? So companies, governments, and global funds often supply them. The financial markets are these different types of financial options, okay, or trading mechanisms, and these are the borrowers, or where the demand for funds come from, okay? Fundamentally from households or individuals. So think about when you are borrowing money for a mortgage, you are demanding funds, okay? And you've got to get that off someone, and that someone is off a lender. And what do you get it through? This middle section here. So they are related. So this presentation is going to look at these areas here. Primary and secondary markets, what are the differences? These are the financial markets, okay, or the different types of options that we have, and you're going to do a bit of research from your textbook on that. A really quick snapshot of the share market or the Australian Securities Exchange in terms of its role, function and effect. And lastly, a really quick look at the similarities and differences in domestic and global markets. So let's get started. Financial intermediaries are firms that often act in between, okay? So they make the loans for other firms who can then go and use them. Businesses may borrow money from a financial intermediary who invest in capital, okay? So these are the middlemen who are actually really important for economic growth and development in the long term. Okay, so these are the bridge, okay, between our borrowers, those who are demanding funds, and our savers in the economy who are actually our supply of funds. The proportion of household income that is not spent on consumer goods is saved. Remember our equation, Y equals C plus S. If you don't consume it, if you don't go and spend it somewhere, you are inevitably saving it without even realizing it. So businesses can save, okay, so not looking at individuals but businesses. Businesses can save by not distributing part of their profits, okay. They can retain these profits, okay, for future investment and all those types of things that businesses may need funds for. We also know that when the government is in a surplus, okay, when revenue, money coming in, is greater than expenditure, money going out, the government is saving, not what we have going on at the moment. Australians can borrow from overseas, okay, to get access from foreign savings. And we've seen the emergence of some of our smaller banks in terms of their market share in Australia, ING, HSBC, because these are international banks, okay? So when you're borrowing money from these banks, you're actually borrowing money from accumulated savings overseas, not the domestic Australian market. I'll let you pause this now and have a look. There are some terms in here that are quite new. Okay, so the main financial markets, we're looking at shares and equity, debt, derivatives. Now, this is a big one. Okay, and I suppose it's important because you possibly haven't come across it. And of course, the foreign exchange as well, dealing with foreign currencies. All right, there are a heap of financial markets. I'm not going to read through them all, but you can see there is not just one type of financial market as in the flow of funds, okay? It can be through business loans, it can be through the share market, it can be through exchange rates, derivatives. And these all operate under either the primary or the secondary market. So let's have a look at these. A little bit of context. Australia is now the second highest level of share ownership per person. A lot of this actually isn't owned by individuals, like as in they've invested in shares. It's actually through their superannuation. So lots of individuals' superannuation funds are investing in shares rather than people's deliberate choices to go out and buy shares. So it's something important to note. We have a wide range of financial institutions. This is one of the areas, that service-based sector in our economy that is growing. And as I said, it's been one of the fastest growing areas. Insurance, all of these types of things are becoming increasingly important in the Australian economy. So let's have a look at the primary and secondary markets. The primary market facilitates the creation. So I suppose you can see that that word is in a different color. That's the key term here, of financial assets known as securities, okay, that then can be sold and then resold and then resold. But when it is created, this is within the primary market. These are used by household, governments and businesses, and the main aim is to raise financial capital, which you know means money, which can then be spent on goods and services. So when companies issue shares or bonds or other types for the first time, now I would highlight or underline that, for the first time, this is in order to raise financial capital. So to get that influx of cash, okay, there might be a startup business, they've been operating for 6 months, but they're running out of cash. They need more cash to go and buy, more of their, to fund their operating expenses or stock. So most of the time, this primary creation is for business expansion, okay? And the purchasing happens directly from the company that is issuing them. There is no middleman. The secondary market, hopefully our brains are ticking over. We're thinking this is where we have the exchange of financial assets that have already been issued in the primary market sometime in the past. Okay, 5, 10, 1 year, but it's already been issued. So this is the exchange generally excluding the actual business, okay? So most of the financial market transactions that take place are in the secondary market. So if you have a look here, I think that this is a really good, clear diagram. When the company sells its shares to investor A, investor gives money to the company sells the shares. This is the primary market. This is the first time that's happened. Now, investor A has had them for a couple of years. They've done well. They've made a little bit of money. They're looking to exit. So they sell these shares to investor B. Okay, investor B gives them some cash. They get the shares, and this is now the secondary market. So none of this transaction had directly to do with exchange within or to the company. So that's important to note. So a really simple example is that if you purchase a brand new car from a dealer, okay, Ford, Holden, Toyota, this is in the primary market. 5 years down the track, you decide to sell that car as a used vehicle. You sell it privately, okay, and this is now taking place in the secondary market, okay. Nothing or none of the exchange when you resell your car goes back to that dealership or the company, so therefore it's in the secondary market. There are other financial markets, and I had these before, but I'm not going to go through them with you. Pause now, have a read, highlight what you think is important. All right, once you've done that, it would be really great if you could pause the video and write, just to make sure that you've got it really clear in your head, your own definition for the primary and secondary market. So pause now to complete that. Okay, once you've done that, this is a bit of an activity that you need to do at home. This document, Types of Financial Market Products, is in your drive. And you need to read page 175 and 176 to complete this table. Now, I want to make this really, really clear. Sorry, I'll just go back. Short and sharp is the key, okay? We do not want that to be 5 pages long. It should be no more than a page and a half, 2 pages, okay? Read, complete it really quickly so you have an idea of the different financial products. Okay, moving on to the third idea, the share market, okay? The share market or the stock market is the market where shares of publicly held companies are issued and traded. We can also call this the equity market, okay? And this is vital, or it plays a really important role in the free market economy, okay? Why? Because it allows businesses to raise capital, okay, or to access funds, as well as individuals or investors having a slice of ownership, and we know that they then receive a return for that through dividends, okay? There is risk. There is risk in starting up a business, and there is risk in buying shares. So it's really important that this is not something that is guaranteed, okay, investing in this type of stuff. All right, we're going to watch this really quick video. As it's playing, can you please take at least 3 dot points?
What is the stock market? The stock market is a place where securities are bought and sold, just as food is bought and sold at a grocery store. Securities. Instead of bread and milk, traders in the stock market trade securities, most commonly stocks, bonds, warrants, and options. Stocks, certificates of ownership. Stocks show that their holder owns part of a certain company. The stockholder who owns a majority of a company's stocks can claim to own that company. Bonds. When a firm needs money, it can issue bonds. The firm receives money from the bond purchaser in return for a commitment to pay that debt later. When a bond is sold on the market, the firm has to pay debt to whoever holds the bond at the time. Warrants. Warrants grant their holder the right to buy stocks in a company at a given price. If the stock prices of a company rise, the warrant can be sold in the market, so someone else will have the right to purchase the stocks. Options. Options are contracts granting their holder the right to buy or sell a specific asset at a given price within a certain time period. Traders in options can make large profits in short time from price fluctuations in the market. The main stock exchanges. All that trade takes place in the main stock exchanges in the U.S., the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. Thanks for watching. We wish you a...
Okay, hopefully that got you thinking about the stock market, but also connecting them to those ideas of the financial products. In Australia, we have the ASX, and this operates as the largest share market in Australia, okay, with investors of all shapes and sizes. Almost 2,200 companies are listed, okay, and these range from well-established large corporations to those small startup companies that are just becoming public. Investors buy and sell shares, okay. There are part ownerships, okay. Around 38% of Aussies own shares. And companies who sell their shares must either be private or public. Now, when we say private, we have something called a private company, and those of you doing business studies, hopefully you know this. But with a private company, there is normally a limit on the amount of shareholders, and they are invitation only, really, to buy those shares. In 2010, the Singapore Exchange actually bought out the Australian Securities Exchange. So it merged, and it's now the 5th largest. So it's one of the largest in the world. I suppose this is a little diagram to show you and to get you thinking about what actually is going on between buyers, sellers, and stockbrokers. Stockbrokers are that middleman, okay, in between. So have a pause of this. Think about the idea of a seller using a stockbroker, thinking about the sale price, the computer system, okay, and then the stockbroker to the buyer, okay. So there is the exchange of these financial products through these different sections. So what's the role and function? Well, the role of the share market can be looked at from two perspectives. Investors can buy shares, okay, whereas our businesses and companies can sell their shares, okay. The main reason investors buy shares is to gain a stake in a company that is hopefully making profit, because the more profit the company makes, the higher the returns for the investor, okay. When you own a share or a stake in a company, you get the right to vote for a company's board of directors, as well as senior managers, who will hopefully maximise the wealth of the stakeholders in the long run. The ASX operates as both the primary and secondary market, but mainly, again, consists of those transactions in the secondary market, okay. When existing shareholders sell, okay, they are selling to another investor rather than through the business. So this is the secondary financial market. There are varying effects of stock markets and security markets on the economy. And it's often said that the healthiness or where the share market is at is a good indicator of a country's economic condition. So with rising share prices, this usually suggests the economy is in good condition, okay, but obviously the opposite can occur as well. The All Ordinaries Index, and you've probably heard this on the news and you've never really thought about what it actually is. Well, the All Ords measure changes in the values of companies listed, so whether or not the share price has gone up or down, okay. Generally, the higher the All Ords are, so the higher the increasing value of companies, we generally see that line up with growth or higher levels of economic growth in the economy. I suppose it's important to know that the share market is far, far, far less stable than the real economy, okay? Its fluctuations swing much more rapidly and are much more volatile than the general economic growth rate, okay? It's not stable, it's risky, okay? It's one of the highest, if not the highest form of investment risk that you can take. Speculation plays a really big role in the ASX and share markets in general, because investors, and especially those that are in the game, I guess you could say, are selling and buying often with the intention of a short-term return. So they're basing their purchase on hype and trying to sell at high levels, okay, and this can often cause swings fairly dramatically in the share market. The share market can also reallocate resources to different types of productions, okay, so different company sectors. Okay, BHP prices rose during the mining boom, of course, okay, which therefore they were able to then use those funds to invest, okay, all of these types of things. But an efficient share market will raise the medium to long-term growth prospects for an economy, okay, which is a good thing. So when shareholders, or when share prices, I should say, are high, for firms within specific industries, using that BHP example, the shareholders will then expect and experience high returns, okay, assuming perfect market conditions and all of that kind of stuff. We then hope that that is reflected in the rate of economic growth, okay, so it can be a sign of where is a good place to invest, okay, about which industries are booming and which industries are driving growth. However, there is always a limitation, okay. When we argue that the market is a barometer or a measure of the economy, okay, we are assuming that all share purchases are based on a rational and genuine belief. And as I said before, many of the share purchases are speculative, meaning that shares are bought with the intention of being resold in the short, okay, in the short term. So these investors are not buying shares thinking, yeah, this is going to be a 10-year thing, this company is going to do fantastic things, growth. They're basing their investment decision off the hype, okay, and not the potential real long-term profitability of the firm. And this can then lead to share prices or industries having an overvalued share price, okay, which can lead to the misallocation of resources. All right, that's kind of it for the Australian Securities Exchange. What I need you to do now is I need you to pause. I need you to go into your booklet, okay, to your Venn diagram, and I need you to write domestic market on this side and global market on this side. And using page 182 to 184, I need you to do the features, okay, and those that overlap. So that idea of similarities between domestic and global and differences or features, okay? That's it, guys. We'll be completing the rest of the handout in class, so hopefully you've got a rough idea of where we're going with financial markets, and you can complete all that work for next lesson, please. All right, thanks, guys.